it's Amy for this month's Aha Moment Live, otherwise known as You Don't Know What You Don't Know. Now, for all of you who are new, welcome, welcome, welcome. Each month we do a live interactive session, I guess you could say, on typically it's the first Sunday of the month, and I try and bring you guys something that you don't know. And when you come on, please say hello. The other Sundays, I post my aha moments, the things that just come to me and occur to me that have really impacted my life in the hopes that it can help you as well. And those are posted every Sunday at 2 o'clock, except the first Sunday of the month. I thought long and hard about what to talk about this week or this month. And what came to me was credit. So let me tell you how I got to this point on wanting to talk to you about credit. Years ago, many of you might not even know this, but years ago, I was actually in the mortgage business. I was a mortgage broker for a little over 10 years. And as a mortgage broker, I used to counsel or coach or educate clients on their credit and how to keep their credit looking good and the common myths and mistakes people made. And then I got hooked in with a woman who actually did workshops for women that were thinking about or in the process of going through divorce in how to keep your credit looking as good as possible. So I would speak to those groups on a regular basis and share with them the things so that they wouldn't get caught, off guard and be unprepared as their husband was leaving or they were deciding to leave that relationship and have their credit totally and completely destroyed. So when I was thinking about it, I have a friend that is going through a rough time. It's on again, off again, and I just wanted it brought me back to the presentations that I did way back when. And I realized that there were so many people that haven't a clue about credit. And these days, credit can really make or break you. And it can cost you so much more to live if your credit isn't its best. So I wanted to bring you some things that you don't know, what you don't know. And I wanted to share with you, I wanted to start off by sharing with you what is a good credit score. I will tell you that what was considered a good credit score has changed over the years. Credit scores range from about 300 to 850. And obviously the lower, the worse it is, and the higher, the better it is. And they used to think that like A+ credit was anything that was 720 and above. And then it was like 740, and now I think it's even higher than that. So you really want to make sure that you know what your credit score is and work on making sure your credit looks its best, so that I'm going to go over some of the things that it actually impacts your credit. Some things you probably have no idea, some of the things that it impacts. But I want to tell you a little bit more about credit so that you have a foundation first. The next thing is, this is a common question I used to get. How is the darn thing calculated? And there is an algorithm. There are 3 bureaus. There is Equifax, Experian, and TransUnion, and each of them has a different algorithm. So they're all similar, but they're just slightly different, and that's why, depending on what bureau is pulled, your score will be slightly different on each bureau because they're weighted a little bit differently. But for the most part, 35% is weighted on your payment history. And they look at, do you have any late payments, collections, charge-offs? These really impact your credit greatly because a third of your credit is based on that. There's 30% that's based on what they call account utilization. And that's a big fancy way of saying your account balances based on the limits. So sometimes we run our credit up, and let's say your credit limit, I'm just going to do a low thing. Let's say your credit limit's $1,000 and you run up your credit card every month and you pay it off, but you run it up to like $800. If someone pulls your credit when the credit bureau has $800 listed because you haven't paid it yet, or you have paid but it hasn't posted to the account yet, then your score is going to drop because it's going to look like you have maxed out that credit. They like to see no more than 30% of the limit being used at any given time. And you say, well, that's not fair. Agreed? But you should know how it works. So if you're looking to get a car loan, or you're looking to get a mortgage, or you're looking to get a personal loan, or anything where they're going to be giving you money, or you're going to be requesting money, you want your credit to look its best. And in order for your credit to look its best, you need to make sure that on the day that it's pulled, the amount of the balance is not more than 30% of the limit. And there's a variety of ways and you can manage this. You can either A, make sure the thing is paid off, or B, you can ask your credit card company to increase the limit so that you know you'll never be over 30% of it. And you just make sure that your purchases stay under that 30%, because 30% of your credit score is based on this. So you don't want to have late payments, and you don't want to have your credit balances more than 30% of your limit at the time that your credit is being pulled. And as always, when you have your credit pulled, it is a snapshot in time. So your credit scores are constantly changing depending on what's being reported. And in this case, if it's being reported that you paid the balance because they've updated the account with your payment, then obviously it would be very different than if they didn't, if it was before it was updated. So 35 for the late payments, and then 30% for the balances, or what we call account utilization. Then 15% is on credit history. How long have you had the credit? The less you've had the credit, the more recent you've gotten that credit card, there isn't a lot of history. So the longer you've had the credit, the higher this 15% is weighted. A lot of people feel that they should cancel credit cards. I will tell you that that is the number one biggest mistake people make, is canceling credit cards. Much better to just stick it in a drawer or cut it up and never use it, because most of the time we cancel credit that's really, really old that we don't use anymore, or a store that is out of business, that the card is useless, or whatever the case may be, and it's better to cut it up and not close it. Now, if they close it on you, you have no control over that. But don't you close out credit cards. It's literally the number one, because 15% of it, like I said, is based on the history. Then you have 10% based on credit, different types. They like to see a variety. They don't want to see all credit cards. They like to see installment loans like mortgages or car loans or things like that. So if you have a mix of credit, 10% of the score is based on that. And the last 10% are on inquiries, or inquiries, depending on who you are and how you say it. And those are when people pull your credit. So here is a little secret. Most people who pull your credit don't know that the system is pulling your credit, and don't know by law they need to ask permission to pull your credit. So if you ever give somebody your social security number for any reason, you need to assume your credit is being pulled. I like to tell this story about years ago. I was moving my money from a savings account into a CD, a certificate of deposit, because it would gain more interest. And I was just going to leave it there for like 6 months or a year until I needed the money. And I had my checking account at this bank, I had my savings account at this bank, and I went in to open the CD. And the girl that was helping me was filling out the form online, and she asked me for my social. And I said, why do you need that? You're not lending me money. I'm giving you money. And she said, because there's a spot here that says social. I said, yeah, what do you plan to do with the social? And she says, well, I'm going to put it in the box. And I said, and what's going to be done with it? And I said, do you know that by law, and I told her, by law, you're supposed to ask me to pull my credit, and I believe that your system is going to be doing that. And she went and talked to a manager, and in fact, I don't understand why someone would need to pull my credit to give me a certificate of deposit when I'm giving them the money for it. I'm not, getting a loan, but they do. So whenever you're giving somebody, this happens a lot in department stores. They'll say, can I have your social? You need to know that if you're giving them your social, they're pulling your credit. And when they pull your credit, that's a ding on your credit report, and that affects 10% of your score. So if you're looking to get a loan, either a car loan or a personal loan or a mortgage, you don't want a lot of people pulling your credit, because that will drastically, affect the score, and you want it to look its best. So that's how it is created. That score is weighted. Again, it's 35% on history, whether or not you've had lates, or payment history, how well you paid on time. 30% on account utilization, your balances compared to your limit. 15% on how long you've had that limit. 10% on different types of credit, and the last 10% on inquiries. So you can better manage your credit by knowing how it's impacted. Now, I get this question. I used to get this question a lot too. Should I pay off my debt? It depends. If you have a charge off or a collection that is really, really old and it's not reporting anymore, then my answer to you, and you're looking to get a loan soon, my answer would be no. Because what will happen is you'll pay that derogatory, what we call a derogatory off, and it will post as a new derogatory that's been paid and whack your score again. And you'll have to wait months for your score to recover. So if you're not looking to use your credit anytime soon and you have some, major derogatory charge off on it, I would just leave it alone unless your lender that's giving you the credit says it has to be paid. And then I would have it timed out that it would be paid at the time of the loan dispersing or shortly beforehand with proof that it was paid, so that it doesn't whack your score, because that really does have a huge impact. I did talk about balances and trying to keep them under 30% or less of the limits. Some people try and keep it around 50%. Do you have to pay them off? It's better if you pay your credit off every month, but come on, let's be real. There are some months that you might not be able to do that. And that is totally fine. Just try and make sure that the balance is less than 30% of the limit if you're needing your credit to look its best. And if you need your credit to look its best and it's a little bit higher, like it's at 50%, and you're making payments, then contact your credit card company and ask them to increase the limit so that it looks like it's just at 30%. That's my little hack. That's my little trick that I wanted to make sure that you got. Let's see, what else did I want to tell you? I already told you, do not close credit cards, please, please, please. Sometimes we get a credit card for a department store because they're offering us 20% off, and we really don't want to have that credit sitting around. So you can have it pulled, open that credit, get your 20% off, and then close it immediately, and that's not going to hurt your credit score because it's brand new credit. It's not giving your score any boost. But if you have it for a while, don't close it. And eventually, a lot of the places nowadays will close it if it's inactive. But I personally wouldn't make that initiative. How much do inquiries hurt your score? So when people pull your credit, it hurts anywhere from 2 to 50 points. 50 points. That's a huge drop. That can be the difference of paying, let's say nowadays mortgage rates are 2.75, I think I heard recently, and paying a quarter or more. So why would you want to pay more when you don't have to? Just don't have too many people pulling your credit. Now, I will tell you, when you do shop around for a mortgage or a car loan, there's a grace period. I typically used to tell people 10 days. Some people tell you 30. I wouldn't go 30 days, you guys. I definitely wouldn't go 30 days. But 10 days, I think you'll be safe. And that is, you can have multiple people pull your credit. So let's say you go to one lender for a mortgage and then another lender and another lender, or I wouldn't advise you, but a lot of nowadays things are online. So you go to a lot of things online. They're all pulling your credit. That's fine if it's in the first 10 days of the time the first time credit is pulled. So if you go on the first of the month to bank A and you have your credit pulled, and then you decide to go to bank B on the 5th of the month, that would still be okay. And then on the 8th of the month you did something online, that would still be okay. But on the 15th of the month, that's going to whack your score again. So just be aware, and if you're going to do your research, which I highly advocate, make sure you focus all your attention and energy on researching it in the first 10 days so your credit doesn't get whacked. It will show up as it'll show up with all the pulls, but it will only impact your score once. And that's true for car loans as well. Because some people will shop, they'll like go to Toyota and then they'll do a used car lot and they'll all be like, well, go and sit down with my finance person and they'll tell you how much we can save you and what your payments will be, blah, blah, blah. And that's fine if you want to do that. Just make sure that you do it in that 10-day window so that you don't have 101 hits on your score, on your credit, that are going to make your score plummet. Another question that I have I used to get a lot, was how many credit cards should a person have? Person should have between 3 to 5 credit cards. Now that is not a license to charge them up. That is a license to have 3 to 5 credit cards. And I would alternate. And you can buy as little as a pack of gum and then pay it off. They just need to see activity, and you want to make sure that there's activity on the credit cards every 6 months. So if you use one card for for those who, I don't have a gas car anymore, you guys. But if you do have a gas car, then use credit card 1 for January and then pay it off. And use one, pay for your gas, and then credit card 2, pay for your gas and then pay it off on the 2nd month, and then 3 on the 3rd month, or pay for groceries, or pay for a sandwich, and just use it once if you want to keep your score looking good, and rotate through the credit cards so there looks like there's activity on them on a regular basis, and that will keep your score looking really good. Just make sure the balances are less than 30% and don't close them. All right, let's see. I wanted to also talk about the 5 biggest mistakes people make with their credit, because as a mortgage person way back in the day, I used to see these all the time. So don't be prey, and don't be the one that falls for these mistakes. Are you ready? So be savvy. Number 1 is canceling credit cards. As I told you, you can, this will really drastically, since the utilization is 15%. So you want your 15% to look its best. So make sure that you pay them down, but don't cancel them, because the history is 15% rather. The account utilization is 30%. So keep them low, but don't cancel them, because that 15% can really whack your score. So make sure you keep them open. The other thing that used to really blow my mind is when you're applying for any kind of loan, whether that's a car loan, a mortgage, a personal loan, or anything like that, and you need your credit looking its best, don't go applying for a ton of credit. Don't go shopping at the furniture store for your new place and want to buy a sofa when you're in the process of getting a loan, and put it on credit, because they're going to then pull your score. And what happens in a lot of these processes for a loan, whether that's a car loan or a home loan, is they pull your credit in the beginning and then they pull it again in the end, because they want to make sure that you haven't taken on any more debt that they need to put into the ratios because they look at that really carefully, you guys. After the debacle in the mortgage industry, they're very cautious of lending money and overextending people. So they pull your credit again like the day of closing. And what I found was people were out shopping for their new place and putting it on credit, and then they had like balances higher than 50%, which plummeted their score, and they got their score pulled, their credit pulled, so that plummeted their score. And then sometimes they wouldn't even qualify for the loan. So don't be caught unaware. And please don't, if you're going through the process of borrowing money, do not go and have your credit pulled in other ways for other things during the process. You always want to stay current on bills. Always, 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 in order to keep your credit looking its best, because 35% of your score is based on that. And I did tell you about shopping mortgage rates or car loans, that you can do that, but keep it to the 10-day window. I really, really hope that these tidbits of information and things that you should know that you might not know are helpful, and keeping your credit looking its best so that you can get the things that you want to get at a lower interest rate. What you might not know, you guys, is that credit is pulled for a variety of reasons. It's not just for mortgages and car loans. Credit is pulled when you rent an apartment. So if you're going to rent an apartment, they're going to pull your credit. If you've had that happen, comment below and let others know. But they pull your credit, and they will determine whether or not they're going to let you lease an apartment based on your credit score. Another thing that pulls your credit is the utilities, the home, the internet, water, gas, electric, all of those utility companies. They pull your credit. And although they might not deny you, they might require larger deposits if your credit is not so good, because they want to make sure they're getting paid. So that would cost you a ton more if your credit score wasn't looking its best. Another thing, this is something that people are like, no. I'm like, yes. Employers pull credit before they offer you a job. Now, they may not base their offer 100% on what your credit looks like, but it does come in and have a play on people who are hiring. So again, these are some subtle things that you might not know how your credit is being used, and therefore not aware that you need it to look as good as possible on a regular basis. Now, once you have your utilities and you rented your apartment and you have a job and you're not in the market to do these other things, you don't need to worry as much. But personally, I would stay on top of it, because it's way easier to stay on top of it than to try and get it back. It's a lot more effort, and it takes a lot longer time to get it back if you missed a payment, or you had a bunch of people pull your credit, or all the things that we talked about. So I'm hoping that this has been useful. I'm hoping this has been helpful. I hope that this saves you a ton of money and aggravation and frustration on learning something that you don't know what you don't know. All right, you guys, what kind of questions do you have that I might not have covered? Because I want to make sure. I saw a bunch of people comment on, hey, Amy and Dilly. Hey, Janet's here. Hey, Janet. And Cindy. When a creditor closes your card because it's been inactive, how does that affect your score? It does affect your score. I'm not going to lie. It does affect your score. That's why I said that you need to have at least 3 to 5 credit cards that you use on a regular basis. Most of us who have been around a while probably have a lot more than that. Because we don't count things like department store cards or gas cards and things like that. But so those are a lot of times the things that get closed out for inactivity. So you should have at least 3 to 5 that you have active all the time, so that you can make sure your score is looking its best, so that the little ones, the the department store ones and stuff like that, when they close out, it won't impact your score as much if you have the credit that you're using. But great question. Brenda. Hey, Brenda and Joanne. Oh my gosh, and Michelle. Oh, I'm so glad you like this, Dilly. Oh, you made the mistake of canceling your credit card. You know, years ago, you guys, I'm talking like a lot, like 30 years ago, I was buying my first house, and my mom told me when I was getting my loan that I should close out all of the credit that I wasn't using, because the thought back then was if you have so much credit extended to you that would count against you in the amount of a loan that they would be willing to give you. And in the old days when my mom was getting loans, that is absolutely correct. But as of like 20 years ago, that no longer is true. So that if you hear that from an older person, it's because that was true back in the day. That is not true any longer. So again, that is the biggest mistake, is canceling of the credit cards. How does daughter's college loan that I co-signed affect my credit? Great question, Cindy. Great question. Okay, so when they pulled your credit to extend the loan, that would have been a hit on your credit. As each month goes by, your credit will slowly increase. When the loan dispenses and there is a let's say they gave her a loan of $6,000, and they paid out $6,000, and she owes, or you owe $6,000, that will negatively impact your credit until it starts to be paid off. Now, installment loans do not work the same way as revolving debt. Revolving debt being credit cards. So I'm going to go back and correct what I just said. Installment loans, because they have maxed out on what they've given you, the $6,000 that she has qualified for, that's not going to impact your score as the same as if you have a credit card that is maxed out at $6,000. But as you continue to pay it down, you will get more bump on your credits, not because the balance is less than the limit, but more the duration. The fact that you have a history and that it's good that you're paying on time, that's going to boost your score more than the balance compared to the limit, because it's an installment loan, not a revolving loan. Does that make sense? Hit me up if you've got more questions about that. So initially, you will get a hit because your credit will be pulled, right? And then, but over time, it will come back and it will give you a boost as long as the loan is being paid on time and over a long duration. So it ends up in the long run being a good thing for you as long as everything is being paid correctly, if that makes sense. What do you think about freezing your credit line so others can't check your credit and pull from your credit record? Brenda, you're going to have to explain that to me a little bit more, because the only way people can pull your credit is if you give them permission or you give them your social. That's the only way they can pull it. And once you give them that social and you sign, like a lot of them have you sign, they're going to pull your credit. You can't really freeze the credit pulling. So I'm not really sure. Now, I know that you can, I'm not really sure what you mean by that. So I might need a little more information. Patsy, wow, didn't know employers pulled your credit. They can do that without your approval? Yes. Yes. Because they'll ask you to sign a bunch of papers and a lot of other things, and in the hiring process, you'll give them your social, and they have the ability to pull it. So You guys, I'm not making this up. You can Google this. Please fact check me if you'd like. But yes, a lot of employers, I would say the majority of employers pull credit before they hire you. Julie, co-signing for son's car. Works the same way because that's an installment loan, not a credit card. So for car loans or student loans, you will get whacked when they pull the credit, and then over time, you will recover those points. And then as the car loan is paid on time, over time, you will get the benefit of that. Plus, it will give you different types of credit. So you have 10% of your score is based on a variety of credit. And if you primarily have revolving or credit card debt, having that installment loan will boost your score. So initially it will hurt, but over time it will benefit. I hope that makes sense. You're welcome, Cindy. All right, I hope that I answered all of your questions. If you have more, or if you're watching this on a replay, please post your questions below and I'll come back and answer them. I feel it's really, really important to make sure your credit looks its best, and you can only do that if you know what the heck affects it. So happy to answer questions, and I'm glad to see that this was of benefit to some of the people on, and for those of you who are watching on the replay. I miss you guys. I hope that everything is going well with all of you, and I'm excited because I don't have to wait a whole nother month to talk to you again. It's just going to be in 3 weeks. Yay! We have froze our credit to safeguard from stealing identity issues. There's been over the years people stealing identity. Interesting. Okay, there are services out there, Brenda, that will safeguard and alert you every time your credit is pulled. I highly advocate for those. My husband has one because our credit was stolen, so we do have that. Another thing that I want to leave you with before I sign off, and that is, if you don't know what your credit looks like, please, please, please go pull your credit. You don't need to pull it on all 3 bureaus. Again, it's Equifax, Experian, and TransUnion. You don't need to pull it on all 3 bureaus. You can have it pulled on just one bureau. And I would go to either annualcreditreport.com, and when they pull it, you will be able to see everything that's being reported and if it's being reported correctly. But they won't give it to you for free, to my knowledge. They won't give you the score for free. They'll give you the report, who's reporting what, but they won't actually give you a score at annualcreditreport.com. If you go to Credit Karma will give you, to my knowledge, you double check, but last I checked, they will give you your credit score for free, and along with your report, because it's really important to look at the report to see if there's any mistakes, because mistakes can be hurting your credit. And even though you might have like a 720, you might actually have a 740 or a 750 if there's a mistake on your credit. So it's good to not only know the score, but to also know what's being reported. And remember that pulling credit is just a snapshot in time. So your credit score is going to change depending on when the creditors report or update their files with the different bureaus. And each bureau has a different algorithm, so their scores are going to be different. That's why, and they get the different creditors report to the different bureaus at different times, and so that's why there's a little bit of a variation between the bureaus and the scores. So definitely pull your score. If there's one bit of homework or one bit of advice, I would say go pull your score at pull your score for free at creditkarma.com, or go to annualcreditreport.com and you can pay a little bit and get your score. Either one Find out what's going on with your credit, because you hate to be surprised. And that's it for me. That's it for me, you guys. I will come back and look at all of your comments and make sure that I answer all of your questions. And I am sending you guys a ton of love. And I'll see you next month.